Hey everyone, it's Mike from Dividend Stocks Rocks. I hope you're doing well. Sorry, I was busy looking at all the comments coming in. As more people are logging in, I'm going to give you a quick tour on what you have on your screen, just in case it's your first time. So on your right side, you have the comment section. As you can see, I have quite regular followers that are here to discuss. We also have Veronique that is with us today. She's our core business manager, so she's going to take care of you if you have any technical problems. Basically, the webinar is best viewed on either Google Chrome or Safari. And if you have any problems with the sound right now, it's a bit normal as more people logs in. After that, it should be all right. If not, just refresh your screen and everything should go well. If you have any comments or question about what I am presenting today, directly in line with my presentation, you can use the comment box. If not, if it has anything, if it's a question about anything else, you can see right below your screen. There is also a question section. There's already three questions over here, actually. So we have Doug, Brian, and Jake asking for stuff. I will stick around for a good 25, 30 minutes, sometimes even longer, to answer all your questions at the end of the webinar. So it's a lot easier for me if you enter all your questions down there, so I can keep track of everything, because as you can see, there's a lot of action in the comment section. So without waiting any longer, let's start with this presentation. So why are you here today? We're going to establish together some guidelines for your portfolio. I know that there's a lot of questions in regards to what's happening on the stock market. How can you avoid rotten apples, so bad stocks that could hurt your portfolio, and how you can buy good ones. I must thank Rick that is here with us today. Rick is a DSR member, and he actually sent me an article about how to find safe dividend stocks at the beginning of the week, and then he gave me the idea of writing a full article that is on my blog right now and hosting this webinar. So when you have ideas like that, just send me a quick email. It's always fun, and then always get more information from my members or my followers, because I know then that it's if someone asks me a question about a specific topic, I know that probably like dozens or hundreds of people are wondering the same question. Actually, today we have close to 600 people that have registered. Obviously, not all of them will be live today with us. There will be a full replay. You will receive the link through an email a few hours after the webinar is done. So if you cannot make it for the whole webinar, you still have the chance to review it as basically it's like a YouTube video after that. You're obviously here to ask your questions. As I mentioned, use the question section right below to ask any questions over there. I'll stick around to answer them, but you're not here to get buy or sell recommendations. Obviously, I am not your broker or your personal advisor. Therefore, you cannot take anything from this webinar or anything that you read from myself or Dividend Stocks Rocks as stock or as buy or sell recommendation. You cannot sue me if you're losing money after this webinar either. I strongly urge you to do your own due diligence. It's super important. I mean, I may come with strong points and well documented research, but still the best person to manage your portfolio is yourself. So please do your due diligence on your side before making any trades. And on the good side of things, you won't have to sue me. You won't have to you won't have to pay me if you're making money after this webinar. As you know, there's a lot of people here that it's not their first webinar. I've done about 50 webinars in 2018. So I'm trying to do something different for my presentation today. My name is Mike Yehu. I am the owner and founder of Dividend Stocks Rocks. If you're wondering what's up with that accent that you're hearing, it's because I'm French Canadian. So English is my second language. Instead of telling you about what I've done at work, I want to tell you a little bit more about my investing journey. I actually started back in 2003. I finished my bachelor degree with a double major in finance and marketing, got my first job at a bank, and then decided to go see my banker, telling him that I was getting married and I need a $20,000 line of credit. And then I told my wife-to-be that I would use that money, but only $3,000 to invest in the stock market and see how it goes. 2 months later down the road, I had the full $20,000 invested in the stock market, and I was making 3, 4, 5 trades a month. So I was not a day trader, but I was actively trading on the stock market. I used to spend 4 or 5 hours a day watching the market, studying stocks on top of doing my job at work. Lucky for me, in 2006, I got married with the same girl, even though I put all the money towards investment instead of my wedding, and I had $70,000 back then, all made from that leverage. Decided to buy my first house, starting a family. Things went well, and then 2008 happened. At that time, I was a financial planner, and I was very busy at work. I was doing my MBA. I had my second children, so now I had like William and Amy to take care of, and I couldn't keep up with spending so much time on the stock market. I mean, 3, 4, 5 hours a day on top of studies and my family, that was just too much. So I was looking to find a different way to manage my portfolio. And while I didn't do that bad in 2008, I was like minus 27%. It's still bad, but considering that I was 100% invested in the equity, it wasn't too bad because the US market was down by 50%. So I was looking for a different way, and I started to read a lot of research about dividend growth investing. And I was convinced at one point that this was the way for me to invest. So in 2010, I bought the Dividend Guy blog from its previous owner, Jeremy McNeil. So some of you may know me under Mike McNeil. That was my pseudonym back then, because I was working back as a private banker, taking care of wealthy clients and also building my online business. So I didn't want to make any conversion between the two. It was clear with the bank that I had the side business, but I was not using my clients from the bank to run my business either. So going forward in 2016, I decided to quit my job as a private banker, travel around the world with my family and my wife, Josie, the same girl that I told that I was going to put only $3,000 in the stock market back then. So she really trusts me. I really found a gem, and I want to keep her forever. And so I traveled the world for a year, and then when I came back in 2017, I decided to work full-time on Dividend Stocks Rocks. This is my own investing platform, and it was built from my my passion about the stock market and my passion about educating other investors to learn how to put their money and make money out of it. So between 2010 and 2012, this is the moment where I decided that I would move all my money towards dividend stocks, all of them. And at that time, I don't know if you remember, but in 2012, everything seems to be going well. And then at one point in time, Greece was about to go default. And that was a big buzz back then because we had 3 years of growth after 2008. So people were still concerned about what's going to happen next. They haven't recuperated much, but still going on the right side of things. But then if Greece goes default, this means that most European banks will not survive this. They didn't have enough time to recapitalize and build a solid balance sheet. And there was a lot of uncertainties back then. Finally, it never happened. Then we had 2013, 2014, great years on the stock market, and then you start reading about the bubble that is about to burst, that the market is overvalued, this and that, and then more concerns are growing. Now we go to 2015, there's an oil bust because all Arabian countries decided to produce a lot more to gain back their market shares. And now they have this whole confusion around the Canadian economy, what's going to happen with Alberta, and everything is going very bad. Well, you're saying today Italy is the new Greece, if you buy the rumor. Yeah, that's right. And the point is here is that you always have lots of rumors. You always have a lot of things that's going sideways. And it would be very convenient to be able to get out of the stock market at each time it's about to go down and then buy at the bottom. This brings us to 2018, which hasn't been a good year for many investors. I was lucky enough; I finished finished a year in positive territories, but it was definitely not my best year. What happened in 2018 is that then again, commercial war, NAFTA going sideways for a while. And then you had like interest rates are rising. Now we hear that the party's over, and towards the end of the year, we were like losing like 10, 15. We even get close to call it a bear market. Some of them call it a bear market, but if you look at the clear definition, the market must go down by 20%. From everything I've seen for the S&P 500, it went down by 19.8 on December 24th. But then the next morning on the December 26th, market went back up. So I wouldn't call it a bear market yet. I'm not saying it's not a bear market, but right now it is not. Maybe it's going to happen in a few weeks. And this brings us into a very interesting moment right now. I'm wearing green today because the market has been green for the start since the beginning of the year, the year end. The week. There's a wind of optimism. We don't know if it's going to last or not. And this puts us in a very strange position as should we sell? Should we get out right now or still buy more stocks or stay invested? And then I went back to my notes. I went back to the work we've done at BSR. I went back to the studies I've done. And I was trying to find a way to get like a straight plan for you guys today. And I came up with something that might be quite simplistic, but at the same time, it will take care of everything all the question that you have and everything that is happening on the stock market. Because whatever will happen in 2019 will happen, no matter what I say, no matter what I think, and no matter what I do with my portfolio. And the same thing goes to you. So instead of going into a very fancy and complex webinar about tons of metrics to look at, we will discuss some metric, but we will keep things simple. So we will get through all those themes going from the most obvious, don't lose money, to offense is the best defense. So first thing, don't lose money. Quite an obvious advice, right? What I've selected here, and I'm going to put it a little bit bigger right now on your screen so you can see. Those are companies that I've cherry-picked in the second half of the year, so between July 1st and December 31st of 2018. You have Budweiser, Owen Miners, General Electric, Buckeye Partners, Artis Real Estate's Investment Trust, Chorus, and AltaGas. So basically, a bunch of US and Canadian dividend stocks that went down by either 30 to all the way down to minus 68% over the last 6 months. And those companies have two things in common. First one, they cut their dividend during that period. And the second one, they were not in our portfolios. That is the critical point here, is not having those kind of companies in your portfolios. And now it's obviously very easy for me to play Monday morning quarterback and telling you, hey, you shouldn't have not put your money in GE. Look at what happened. But I'm going to explain you how we went through our all process to make sure that those kind of companies are not in our portfolio and that we don't suffer a dividend cut. Because what happened back then in the last 6 months of 2018 is no matter where you were, the market was down. So the S&P 500 was down by 8%. That includes dividends. So that's the total return of I used the SPI, so the Spider Index. Same thing with the XIU, so iShares S&P TSX 60 for the Canadian market. Canadian market was down -10, US market was down -8. So basically, pretty much everywhere you invest last year for the past 6 months, you were showing negative return. Same thing happened with my own personal portfolio. I was just lucky enough that on the first half of the year, I made enough profit that at the end I finished with I think it was like plus 4.5 or something like that. So what I've been trying to do with DSR and with my portfolio is to find ways, find tricks, find tools or identification to avoid picking companies that would cut their dividend. The reason why is, as you saw in the previous graph, is that when a company cuts their payout, obviously another thing happens. Chances are shares are going to go down as well, because when a company cuts its dividend, it's they break the bond with the market, the bond of confidence. And basically they're saying to the world, the business is not doing as we expected. We need more cash flow to do something else, either a project or an investment or an integration of an acquisition. But overall, we're having problems and we need our money. Deb, you're saying I got out, put my money in term deposit in 2018 and didn't lose any money. There were lots of indicators to see a bear market was coming. Good for you, Deb. But actually, like I said, the bear market is not really there so far. And if you have invested properly, you probably would have not lose money. So yes, it's convenient. And you can say that there's a lot of indicators, but then that would be very, very interesting to know which would be the indicator saying that the market was back up. So according to my crystal ball, I don't know if December 24th of 2018 was the bottom of the market or not, because since December 24th, the market is back up by 10%. So then again, very hard for me to tell and very hard for pretty much anybody to tell what's going to happen next. And yes, Rick, that's okay. If you stay invested and you cash a lot of dividend, you don't have to worry about the potential bear market, because in the next 18 months, the stock market will recover. And this is one thing, one parenthesis I will do for retirees. If you're retired and let's say you're 68 today and you live off your pension income or your dividend or your portfolio's income, and you're worried about the stock market, think about it this way. If you're 68 today, chances are you're going to live until you're 85 or even 90 or maybe even 95. So this means that you have 15, 20, 25 years to invest in the stock market. This is not the last bear market you see, and it will not be the last bull market either. So it's going to go up and down, and usually on average, it's go back up within 18 to 24 months. So if you have a strong strategy, you don't have to mind too much about the bear market. Honestly, as I mentioned, the S&P 500 went down by almost 20% in the second half of the year, and I didn't feel it. I was like maybe -10 for that part, so it wasn't that bad. So what we did at DSR is we tried to identify those companies throughout a methodology and a process that I will share with you today. What I want to share with you right now is that we have established a rating. I'm going to share my screen for a second with you. All right, so now you're on my screen. Going to Dividend Stocks, I'm going to show you our rankings. So let's go with the US ranking, for example. So I was looking as an investor for a tool that will tell me which company is likely to increase its dividend, cut its dividend, or it should be a buy or a sell. So we came out with a pro rating that is a regular classic from 1 to 5. So 1 being a screaming sell and 5 being an exceptional buy. So I guess you can see right now that Apple is rated as an exceptional buy. Obviously, stock lost about 35% of its value recently. So it's a very good pick right now. And a dividend safety score, which will tell you if the company would perform well in terms of dividends. So going again from 1 to 5, 1 would be a dividend trash, which means that it has cut its dividend or will cut its dividend shortly, and 4 and 5 ratings showing a high single-digit to double-digit dividend growth perspective. So this rating has been established since the beginning of 2018. We in February last year, we launched an upgrade called DSR Pro, which is basically a way for us to track the results of earnings for each member's portfolio. So basically, the DSR member who wants to become pro fill out the form. Obviously, there's a cost for it, but that's beyond the point. And then he gives us all his portfolio holdings, and we track them 4 times a year. So after each earnings season, we give them a summary, and we rate all the stocks. So what we did back then on July 1st, we sent our second report of the year, and we analyzed over 1,000 companies. Over those 1,000 companies, we had 141 sell ratings, so either a 2 or a 1 rating for our pro rating. The average performance of this group was -18%. So while the market was down 10 or 8%, depending if you're Canadian or American, the stocks that we recommended selling that we didn't like for whatever reason was either on average -15% on the Canadian stocks or -20% on the US stocks. So obviously the system is not perfect, but what I'm about to present you are the guidelines that we use to identify our pro rating or dividend safety score to help you out understand if those companies should still be in your portfolio today, or you should sell them and avoid those potential dividend costs and obviously lots of loss on the stock market. Rick, you're mentioning all the FANG stocks have become highly volatile in the current market. You're totally right. What's happening with the FANG? For those who don't know, FANG is for all the big tech stocks. So we're talking about Facebook, Amazon, Netflix, Google. You can add Apple in there, but basically it's more like the FANG to include Amazon and Apple. But those companies had an amazing run over the past 10 years. They obviously now they get a very important part of the S&P 500 in terms of market capitalization. So anything that happened to this small group of stocks will influence the rest of the market. And we'll get to sector allocation later down today. But this is something that you may take very seriously. Even personally, I'm a big fan of tech stocks that are paying dividend. At one point in time, you must not put all your money into a single sector, or you're going to get hit seriously. So the second thing, now that you know, like the rating works, but the rating works unless you it works only if you know why you buy and why you sell. So I'm going to take a real life example here. I'm a big fan of Lazard. It's an investment manager and a deal broker. So 50% of their business is a classic asset manager. So they're basically investing in the stock market and offering investment products for pension plans and stuff like that. And the other half of their business is for brokerage deals. So merger and acquisition or restructuring program. I've been talking about Lazard for some time now. I have it in my own portfolio, bought it in 2017 when I quit my job and I received my pension plan. I received over $100,000, invested it all in the stock market. Lazard was one of my pick. As you can see on this graph, the stock went as high as $57, $58 and lost about $20, go down to 37. So some people are saying, well, Mike, you keep telling us how Lazard is a good company, but all I can see right now is the stock going down like 40%. So how is this helping me? How is this helping my portfolio? Because I mean, losing 40% is a lot of money, right? So I'm going to share my screen back again and show you the reason why I think that Lazard is still a good pick. And I'm not going to sell it in my DSR portfolio. I'm not going to sell it in my own portfolio. So other things here, when you're on the website, you can type any stocks that we cover here. We cover over 325 stocks right now, both Canadian and US. You just have to type the ticker or the company name. So you have the stock cards, you click right here, and then what's going to happen is you're going to get this stock cards. Those are stock reports. This one has been updated back in November, so it's fairly fresh. All our stock cards are being updated twice a year to make sure that we don't miss anything. And if there's a dividend increase or a dividend cut in the meantime, we'll do our best to update the stock cards within the same month. One I want to drag your attention here is to go back here in my investment thesis. I will let it read it for you, but basically the reason why I think that Lazard is a good company is that they have built a solid reputation as a deal broker. So they're highly involved in merger and acquisition activities. And when the market slows down and then we hit a recession, then their services are needed for a restructuring plan and to make sure and refinancing plan. So they're basically winning and getting market share regardless what's happening on the market. If it goes well, we're going to talk about EMAs, and if it goes wrong, we're talking about restructuring plans. In terms of assets under management, they have a specialty in terms of real assets. So we're talking about infrastructures, pipelines, bridges, toll roads. Those real assets are quite interesting for investors because they don't necessarily follow the stock market and they're hard to invest as a single investor. But when you're like Lazard, you can put several $1 million into a single project, then they can actively participate on it. So this is my investment thesis. This is the reason why I like the stock. On the second page, you have the revenue, earnings, and dividend going on. As you can see, the company is paying a special dividend each year, but the dividend is also increasing at the same time. Revenue is increasing in 2018. Earnings are quite stable on that year. And if you go into their presentation, what I found very interesting, and that was the presentation that they did in October 2018, they're generating a lot more cash than earnings. So this is why earnings is not too bad. Free cash flow is king. Wish they had the 2018 numbers on their screen, but they didn't. As you can see, they have lots of them. The two screens later, you see the dividend growth going on over there. So basically the blue part, the dark blue part is the regular quarterly dividend increasing year after year since 2017. So even during the crisis, they were able to increase it. And now, since 2012, they had this tradition to share the wealth with shareholders. So any excess of performance, they're paying out a special dividend. So it happened also in 2018. I'm expecting a special dividend also in 2019. And finally, they're buying back shares. The discussion in their latest quarter was to either use their extra money to buy back more shares or to pay an extra dividend. So basically, all that to say that if I review the stocks, because if I review the stocks and I wonder why the stock has been down by 40%, if I look at the sector instead of looking at the portfolio, at the stock itself, I will realize that Franklin Resources, BlackRock, Invesco, and pretty much all the other asset manager were down in 2018. So it's a sector thing. It's not linked to Lazard, and my investment thesis remains. So I don't need to know if what's going to happen with the market. As you can see, similar phenomenon happened back in 2016 when the market wasn't too sure about what's going on, as China has a lot of volatility on their stock market and seems to have an economy slowing down. But overall, the company Lazard was doing well, and there was no problem with the company itself, so the stocks went back up. So if you know why you buy, you will know why you sell. And this is the importance of having a strong investment thesis and write down all the reasons why you think a company is good or not. Thank you, Vero, for taking care of Russell here. I see that there's a lot of comments about sounds. I hope that everybody else doesn't have any problems. My side, everything runs smoothly. I can see that we have a lot of people that are logged in, so maybe that's the case. Sometimes the webinar requires lots of juice for the internet. Thanks, Errol and Kim, for confirming that everything is fine. So moving on now to key metrics. As I mentioned, I could have done a webinar solely based on metrics, a little bit more technical. If you like, since you have registered to this webinar, if you go back into your Webinar Ninja account, where you can see my webinars, you can go back in a few months ago. I did one about dividend safety. I go deep inside more metrics, a little bit more technical. So if you're more interested about those things, I suggest that you go there after this webinar and watch it. All our webinars are free, so you can watch them whenever you want. So back to the key metrics I'm looking. Those are my starter key metrics I use. They're non-exclusive. They're not set in stones either, but those are the metrics I use to pull out my first stock search. So basically, I'm looking at companies paying between 2% and 6%. The reason why I don't go higher than 6 is because there's no free lunch in finance. I'd rather have companies that are paying a smaller yield but has better fundamentals and leader in their market than going after a big chase on yield and having companies paying 8, 9, 10% yield and end up with no growth, no dividend growth, no stock growth, or basically a dividend cut at one point in time. The other 3 metrics I look at is what I call the dividend triangle. So revenue, earnings, and dividend growth, all of them together. So basically making sure that a company has a business model, growing their business, making more money, and then sharing it with their shareholders. The most important metrics over there is definitely dividend growth. Why? Because if a company grows its dividend year after year, it shows that management has confidence in their business, that they have enough cash flow to run their business, run their project, and also share some wealth with investors. And most of the time, those are the companies that are well equipped and has a solid balance sheet to go through potential bear market or recession. The other thing I look out is the payout ratio. I've mentioned payout ratio and cash payout ratio. Depending on the stock you look at and the sector, it could be something else. Depending if you look at utilities or REITs and stuff like that, you'll have different metrics to see. Then again, I've covered that in the previous webinar about dividend safety. We're talking about adjusted fund from operation payout ratio, or net interest income, or distributable cash per shares. So all those things. But basically, the idea here is to make sure that the company grow and that the payout ratio seems reasonable to not only continue paying that payments, but also being able to increase it. Yes, Garth, you're right. Lazard payout ratio is over 100%, but not their cash payout ratio. So that's the main difference. And as I showed in their presentation, they're generating a lot more free cash flow that they're generating earnings. Because the thing with earnings is that it's an accounting figure. It's not cash in your bank account. So this is the difference. Hey, sorry to see you go, Russell. At least you'll be able to watch the replay. But there's what I don't like about metrics is that there's a big problem with them, and it doesn't tell you the full story. It tells you it's like a picture of something happened, but it doesn't give you the whole story behind it. A good and an interesting real life example is what happened with AltaGas. When we first look at AltaGas, back in at the beginning of 2018 in the SR. It was a request from one of our members, so we looked at it and said, you know what, stocks look good, metrics look decent. They just had acquired WGL, if I remember correctly, major transaction to open their to open their business model towards more diversification through natural gas. Great deal, sounds like a plan, but even though all the metrics were pointing into the right direction, and then we kind of liked the stock, we decided not to add it in our portfolio, and we added this mention in our stock cards. We ended our analysis by saying, you know, when things are too good to be true, when it tells you that you know, at AltaGas back then was paying like a 6 or 7% yield, so it was like kind of the perfect investment, and we couldn't figure out why the stock was paying so much in dividend. So we were saying, if it sounds too good to be true, it probably is. So even though we're not able to pinpoint the problem, we're going to let this one aside and will not invest our money into it. And then in the end, what happened is the management surprised the market, saying, oh, we're going to put an end to our drip program. So that started the big drop in 2018 during their latest earnings release. And a few weeks later, they came back with another announcement saying, oh, by the way, on top of stopping the drip program, we're also going to cut our dividend. So it was already pretty much priced in the market at that point. A lot of investors were expecting that dividend cut, but the fact that it wasn't announced up front and it took like two announcements to do it, it was probably even worse for the stock. So the reason why I don't like just looking at metrics is this. So I use a first set of metrics pretty much to set the rules on. I'm looking at something that, like a company that is growing in terms of revenue, earnings, and dividend, and then I'm going to go deeper, and I'm going to look at trends instead. So trends are more powerful than metrics, and I'll tell you about Microsoft example. For right there in 2018, as you can see, there's a big drop in the earnings per share. So all of a sudden, the earnings of Microsoft dropped down like a rock. Does it mean that they missed earnings? Does it mean that they are not making enough money? Not at all. What happened is in 2018, the tax bill came into play. It generated lots of adjustments. Sometimes it was positive, some others was negative. In terms of Microsoft, they had to register the provision for taxes, and this what brought the earnings per share down. So as you can see, the graph there is the total trailing month. So basically now it's going back up, and then in 2019 it's going to keep going back up. So what I look at when I look at trends, and what I like for trends on top of the metrics I've mentioned, is to look at the free cash flow, the debts as well. So any jump or any drop, that will tell me there's a story to tell. So this is where I'm going to pull out the quarterly statement or the annual statement, and I'm going to read what the CEO has to say about his latest earnings, and then discover what happened with that trend, what happened with that big jump or this big drop. Another example I could mention would be Disney. I'm a big fan of the stock. I think that the company is doing well, but obviously in 2019, now that they have acquired Fox, their debt level is going to go through the roof because they paid, I think, like $70 billion to acquire Fox assets. Is it concerning? Yes and no. Yes, it's a lot of debts, but I think that Disney can make it happen. But the whole thing is, I get back to the reason why I bought Disney in the first place, my investment thesis. And my investment thesis is quite simple. Disney is able, has this unique ability to take any piece of content and then create multiple streams of income from it. So they buy a character, they buy a series, and they make movies, they make apparels. Now they're going to go streaming in 2019. So they're going to be able to use and exploit that piece of content, this license, into numerous stream of income. They did it with Pixar. with Toy Story and Frozen. They did it again with Marvel. Obviously, that if you look at the top 5 movies, blockbuster movies, year after year, you have 2-3 Marvel movies year after year all the time. And they did it again with Star Wars. So they're raising debt to buy Fox. I don't mind. Totally makes sense. They're going to do it again. Sorry, lost my train of thoughts. So instead of Jay, the question section is right below your screen. You can see that there's already 15 questions over there. So you just type in your question and then it's going to appear over there, but it's easier for me to track when I answer. For the record, I'm almost done. I have like 2 more slides to discuss and then we're gonna hit all the questions over there. So last piece of advice over there is offense is the best defense. If you're unsure about what's going to happen in the stock market in 2019, if you're unsure if we are on the verge of a recession in terms of economic data, or if we're going to hit a bear market this year, your CFD, you can put your question about Enbridge in the question section. It will be easier for me to answer all those questions at the end. So if you're unsure, pick up companies that shows strong growth vectors. Here I've taken quite easy example, Royal Bank and Starbucks. As you can see, all the metrics, revenue, earnings, and dividend are going towards the same direction. So the overall thing is, if you go back in time in 2008 and look how Royal and Starbucks reacted during the bear market, during the crash actually, they lost 50% of their value. So they didn't do any better than anybody else. The key point is look what happened afterward. So both Royal Bank and Starbucks jumped back very fast. Why? Because investors realized, oh, those companies have strong growth vectors. And even though the economy is going down and the market is going down at the same time, those companies are able to grow their revenue, grow their earnings, and eventually grow their dividend at the same time. So this is the kind of company you want. So instead of going cash and hope for that bottom, and I read all kind of things from investors. Some investors are saying, oh, I'm going to put back my money once the S&P 500 hit 2,000 points. It may happen, it may not happen. In the meantime, I rather cash dividend. And you know what? Even though the stock market drops, within the next 2 years, it's going to go back up and you're not going to lose any money if you're well invested. And this is probably a key element over here. And this is what we see so many times at DSR Pro when we do the portfolio review for our members. We notice that we have a lot of people, a lot of investors investing 40, 45, 50% of their money into a single sector. Taking out the legends out of those graphs, I didn't want to discuss which sector is best, which sector is worse. It doesn't really matter. If you have 50% of your money invested in one single sector, 2 things are going to happen with your portfolio. You're either going to outbeat everybody, so you're going to outperform the market and outperform all investors, or you're going to finish down the drain. Because if the sectors go well, your portfolio is stellar. And if the sector goes wrong, then you're going to cry. So instead, try to use key metrics, strong investment thesis to select the best performing or the leaders of each sector that you're interested in, and having something that looks more like the chart on your right side, where you have not really more than 20-25% invested in a single sector. Depending on the sector, if you're looking at industrial or consumer staples or consumer cyclical, those are wide diversified anyway. So you can have like 25%, even sometimes 30% of your portfolio into those sectors, because they're not like the way that 3M will react versus Lockheed Martin or Canadian National Railways are 3 different companies, but they're all fall into the industrial sector. So this would not have the same impact. So this is not too, you should not be too concerned. But if you put all your money into REITs or into utilities or the energy stocks, then you're gonna get hit big time. And I think that this is the key for 2019. Select the best of breed for each sector instead of trying to guess which sector will outperform the others. So now we're going to move towards the question section in a second. Right before, I want to make a special offer for you. I usually, at the end of the webinar, I always offer you the possibility to register at DSR at a reduced price. So that offer still stands, but I'm adding a few bonuses this time. Those bonuses, if you're already a DSR member, you can already find them in the newsletter section, actually. So basically, I'm offering you the 2019 investor package. If you are interested in looking into the whole package, you can just go down in the right where you see the question section. You also have the offer button, so you can get there or follow the link I put in the comment section. So basically, the investor package is the Dividend Toolkit. The toolkit is a 200 pages book all about dividend growth dividend growth investing. Actually, it was written by Matt Alden. We bought the right on the book, and the right on Dividend Monk is a previous blog. Matt is an engineer. So if you know any of your friend or family member that is an engineer, you probably know how well detailed their research are in pretty any aspect of their life. So he did literally a monk job working on that book. The main advantage from this book is that you will understand how to use the dividend discount model and the discounted cash flow method analysis to determine valuation for your stock price. Excel spreadsheets are included in the book. So you get the book, the Excel spreadsheet, and now you can calculate your valuation by your own. So that's pretty cool. Second thing that we're offering is the best 2019 dividend stocks book. Year after year since 2012, I select 20 US stocks and 10 Canadian ones to beat the benchmark, to beat the market for the next 12 months. Since 2012, I failed only one per market. So only once on the Canadian side and only once on the US side to not beat the benchmark with my average. So those stocks are pretty good picks. They're obviously based on our investing models. Most of them are on my personal portfolio, obviously, as well. So I'll let you go look inside, look at the link that I've posted in the comment section or the offer button. Just going to show you where to get it. Oh, and I have another bonus for you. Actually, I'm going to show you how to get it. If you go on the webpage, webinar promo, you go a little bit lower. So as you can see, total price for this package would be $200. You get it for $97. You can pay in Canadian or in US. So that is up to you. I know how frustrating it is as a Canadian to pay stuff in USD right now because of the the currency exchange. So I'm offering you the same content, same everything, in the currency of your choice. If you're American, if you want to pay in Canadian, that's fine with me, but I'm not responsible for any currency fees or change going forward. Later down the road, if you go right below, right here at the middle of the section, there's get your free reports. You can download the list of the 141 stocks that had a sell rating back in July 1st, 2018, and the list of the 126 stocks that had a buy or exceptional buy rating at DSR Pro. So this is a unique opportunity if you want to double check your portfolio with those lists. The buy list actually outperformed the market. It was still on average down for that 6 months, but it still did better than the market. And as I mentioned earlier in this webinar, the sell ratings did minus 18% while the market was down about 8%. So basically, those were definitely stocks to avoid. I think their system isn't flawless, obviously. So you'll see some sell stocks that actually posted a fair amount of return, but overall, you're going to get something very interesting to double check reference. And this is free. So you just go there. It's webinar-promo. Download your two lists, even though you don't want to register to DSR, and you'll get those lists to cross-reference with your portfolio. Gregory, you say that you subscribe for the 1 year DSR on Seeking Alpha. You want to switch the subscription for DSR? Yes. Just send me an email. It will be maybe easier for you, and we're going to work it out. Veronique, can you just send him an email, not an email, but put my email here in the comment section. As I have lots of questions, and I want to make sure that I spend more time answering your question than pitching my my service, I'm going to go directly to the question section. So Doug, you're asking, would you please comment on, I think it's Canadian Utilities, right? cu.to. It has good credential, but does not feature prominently on dividend stocks recommendation. And I see that you have 2 other comments. Ronald say, Doug, I held CU for a couple of years, but got out based on their coal fire plant holdings. You might consider Northland, NPI, or EMRA as alternatives. And Rick added other potential Canadian utilities picks are Fortis and Algonquin. Doug, actually, I must tell you that both Ronald and Rick are DSR members, and I actually share their view in terms of EMRA, Fortis, and Algonquin Power, AQN, as alternative. I'm going to share my screen a second, and I'm going to discuss a little bit more CU with you guys, because I have it right here. So I'm just gonna go back. So ranking, Canadian. So let's take a look at CU now. So right here, CU, there you go. So we still have a bro rating of 4 and a dividend safety score of 4. Main concerns, however, is still around their coal plan. The thing is that they need to invest lots of money to transfer their business model outside of coal. They're getting help from Alberta, so that's great. As you can see, this one is a little bit old. It's being reviewed. Probably it's going to have an update next week or in 2 weeks, as we are finishing the June updates at DSR. The holiday season, obviously we're closed for almost 3 weeks during that time, so we always have a little bit of lag when we start in January to update our stocks. But Canadian Utilities, it's a great company. But the problem with coal remains. The other thing that I'm not too sure about it is that they need to invest a lot of money. We're talking about $4.5 billion to be invested in the upcoming years. So considering that interest rates are rising, considering that it's an Alberta-based company, they might get the consequences of the energy slowdown over there. So the economy might slow down in Alberta, so might use less electricity and resources. So for those reasons, I'd rather go with either Algonquin or EMRA. Both of them shows a better exposure to the U.S. market as well, and Fortis is probably like the number 1 utility stock that you want in your portfolio. So definitely those 3 are probably better than CU or ADCO. Then again, not a bad pick, but would not be my first one, to be honest. Brian, you're saying, what are your thoughts about Vanguard portfolios such as VGRO or VBAL for retirees? Just bear with me a second. I'm just going to take a look at which kind of ETF portfolio it is. Unfortunately, I don't know them that much. So we're talking about growth ETF portfolio. Do we have, and the other one is VBAL. So a balanced ETF portfolio. So basically what you're talking about here are made for you portfolios. I think that if in terms of any kind of portfolios, when you look at companies that shows like low fees like Vanguard, it's probably best than mutual funds. The reason why I don't go the ETF route or the portfolio made for you route is because I like to invest I like the stock market. I like to read about it. I like to get involved in the pick that I'm making. However, it's not for everybody. I think that successful DIY investors will have three things. They will have the knowledge, they will have the time to spend on their portfolio, and they will also have the interest, so the passion about the stock market. So if you don't have one of those three, you're probably better off going from either a growth or a balanced portfolio. Now, the choice between the two is very personal. It really depends on your risk tolerance, because as a mathematical standpoint of view, the growth portfolio should always be the best one. It's quite normal because over a long period of time, the stock market, the stock market will perform well, so growth will outperform balanced portfolio. But if you didn't feel well in 2018 with your portfolio, if you're scared of a bear market, maybe you're better off with a balanced portfolio at that time. But definitely going with a well-known company such as Vanguard, such as BlackRock for their portfolios and their solutions, that could be something very interesting for you for investors that don't want to spend too much time managing their own portfolio. Jake, you're saying, does a good dashboard exist to monitor, evaluate dividend stocks that have increased, decreased, dividend growth, etc.? Keith, you answered already. Globe Fund used to, but could this be DSR service? One-stop shopping. Thanks, Keith. Actually, we do track a lot of things like this. As I mentioned, we the advantage that you have with a platform like Dividend Stocks Rock is I'm not the only employee there. I'm the founder, and we're looking to grow. But with the DSR Pro model, and if you're interested in DSR Pro, you just have to scroll down all the way down to the bottom of the page. We have an offer for DSR Pro as well. Basically, the difference between the two is that you have a customized report on a quarterly basis. Most of the time, people likes to try DSR first, and then when they're comfortable with it, they move towards Pro. But with the Pro system, we cover over 1,000 stocks. I think we're like at 1,200 right now, so 1,200 Canadian and US dividend paying stocks that we cover on a quarterly basis. So whatever happened in terms of dividend increase, dividend decrease, revised guidance, sector things, we also look at everything like that, and we advise our people. Yeah, thanks, Rick. Seeking Alpha has also a very good platform over there. You can they offer various packages where you can get lots of information also. But yeah, I would definitely, regardless of which kind of service you look at, I think DSR is one of them. Obviously, I know I'm biased, but it's one of them still. Another one would be Seeking Alpha, definitely. Personally, we use Y charts. We have a professional subscription. I will not lie to you. It costs a few $1,000s per year. I think it costs about like $3,000 or $4,000 US for us per year. But we have amazing tracking over there. We have access to unlimited data for pretty much anything that we want. So basically, it's really worth it for us as an individual investor. Not too sure. I think you have other services like Seeking Alpha and mine that is probably more affordable. And in both cases, also for Seeking Alpha, they do have a refund policy as well. So for DSR, you have 60 days. So if you register today, you can download the Dividend Toolkit. You can download all the lists, all the portfolio models. You can download our best picks. And then in 30 days from now, or 60 days from now, you can send me an email saying, Mike, DSR is not for me. Can you please refund my money? I'm not going to ask you anything. I'm just going to send back the money, and then I'm going to ask you why you decided to cancel your subscription. But in the end, the money will be on your credit card already, so you don't even have to answer me. Kevin, you're asking, why don't dividend ETF based on Dividend Achiever also increase their dividend annually? Or are any Canadian dividend ETF that have increased their dividend every year for 5 years and older? That is a very good question. Honestly, I don't track ETF that much. I would not be able to tell you what's happening with their payment. Just gonna bear with me a second. I'm just gonna take a look at something here quickly. Never look at how the dividend was progressing from one quarter to another, actually. Mostly because we're using dividend ETF as a benchmark, but we don't have to track what's happening over there. Dividend, there you go. So yeah, the dividend is variable. Overall, it still increased probably, but because they move according to their greed is larger than yours. That's why. Good point, Emil. No, honestly, I think that it's because they have to rebalance the portfolio. They have to add stocks and stuff like that. So that's probably why it's not perfect. And they're more interested in tracking the underlying the stocks. Instead of growing the dividend. I mean, keep in mind that when you're looking at dividend ETFs, you're looking at a package, you're looking at the portfolio, you're not looking at stocks that wants to share wealth with investors. Kevin, you're asking, what option would you recommend for an RESP? As you know already, I have 3 children. My oldest one, William, is on high school, secondary 2. My youngest one, Caleb, is 6. I have a family RESP for them. I mean, when you, depending on the age of your kids and the time frame that you have, on my side, when I set up the account, I think that William was like 6 or something like that. So I knew that had about 15, 20 years, like more likely 20 years because Caleb was just born at that time. So I went all in stocks, 100% in stocks. I will tell you that I was a bit nervous at first because it was not really my money. It was my money, but for somebody else. So I don't mind putting 100% of my portfolio in stocks for my retirement because this is my money and I'm responsible for it. For RESP, I was a bit nervous at first, but then I decided to go this way. And I also invested in US stocks, even though it's a taxable account. I mean, they're withholding 15% of the dividend paid for US stocks. But you know, I've had like Starbucks and Apple in this portfolio, and Union Pacific, so all of them are showing great returns. So I don't really mind about that small 15% taking out of my account. So I would say if you're not comfortable managing your portfolio on your own, go with, as we mentioned earlier, Vanguard or BlackRock ETF portfolios. Those are great. Another great solution for Canadian, you can go with robo-advisors. They don't cost too much. If you're starting to invest, it's a very good solution as well. Most banks are offering one. Wealthsimple is offering a free one, I think. You might want to look into that. I don't know if it's applicable for RESP, but those would be my recommendation. Basically, invest the money the same way that you would invest it for a retirement, because it's going to take a while before you invest the money. And at one point, probably that you're going to reduce your exposure to equity as you're getting closer to withdraw part of that money, because this account will be dead in 25 years. Your retirement account may live for like 40, 50 years. Fred, in the comment, you're saying, Mike, maybe I missed it. How does your service highlight sound stocks that are currently undervalued? I'm familiar with how FastGraph does it. Oh, you can use the ranking, as I mentioned. So when you do your own research, if not, each Friday we send a newsletter. So on each Friday we highlight some stocks that we like. We review specific sectors. So basically one sector each month is being reviewed where we will highlight undervalued stocks that we like. And we also have a buy list that is updated through that weekly newsletter, telling you which one we like, which one is undervalued and stuff like that. So you'll have this information over there. And each stock that we highlight, we always have the stock card where you can just click on the ticker and get more information. So basically the stock cards are 2-pager. Yeah, it's each Friday. Do you have any problem receiving it, René? Basically you have 2 large issues. So you have one on the first Friday of each month, where we look usually at either our portfolios or a sector, and we have a second one, which is the Mike Buy list, which we update on a monthly basis. The other two issues are basically more general. We're sending new stock cards that are being updated on a weekly basis. We add between 5-6 new stock cards and update about 10-15 stock cards per week. So for a total between like 15 to 20 stock cards each week that are being updated. While you're asking, we know a US recession is coming. Yeah, like I feel like in Game of Thrones right now, like winter is coming. Maybe next year, maybe next week, somewhere in between. While this last quarter saw stock price drop, even as the company have performed relatively well, isn't it prudent and preferable to wait and buy after price drop even more? What an empirically sound strategy under these conditions. And John Ford, you added, very difficult to time the market. Evidence is that most managers are unable to time things perfectly. Being out of the market on 1 or 2 ups days can dramatically affect cumulative return. You know what, John? You just answered for me. If I'm going to go back on my screen here in the presentation, go back to one of the very first. Yeah, there you go. That's the slide I'm looking for. So if you go here, this is the S&P 500 for the past 10 years. As you can see, lots of ins, lots of out. If anybody right now in this webinar was able to time them, please tell us your secret. Because even though someone that have been stayed invested made a lot of money, someone that had been out, each time I've put on this graph and back in each time I've mentioned it, would have probably doubled his money compared to someone who stayed in the market. But that is impossible to predict. That is definitely not something that you can do. The reason why, it's quite simple. Right now, you mentioned, stock market got down in the past 6 months, but the economic numbers were great, both on the Canadian and the US side. Unemployment rate still low. House construction slowing down, so obviously that's a concern. But companies were pulling out great numbers as well. And keep in mind that there's no link between what's happening on the stock market and the recession. Usually, stock market drops will actually be an indicator that a recession is coming, but sometimes the stock market drop and there's no recession. So yes, a US recession is coming, but it's like saying that it's going to rain, or actually it's going to snow tomorrow. One day you're going to be right, that's for sure. But you know what? I'd rather not put my rainy coat or my toque and my mittens on and keep going with my portfolio, because you won't know when to come back. I remember that there was Deb mentioned that she got out at the beginning of 2018. It could have been a good strategy for her, but as I mentioned, my own portfolio, if I have gotten out in 2018, I would have lost like 4 or 5% on the table. That's not lost, but not. I finished the year almost plus 5. So basically, this is 5% I would have not gotten. And between December 24th and today, the market is back up by 10%. So are you back up? Are you back in? Are you back out? Like, what are you going to do? Basically, nobody knows this question. And you know what? What's going to happen in the next couple of weeks? I'm going to tell you right now. 2 things going to happen. We're going to have a great earnings season, and the market is going to keep going back up. And we're going to have like the settlement with China in terms of the commercial trade war. And I don't know if the wall is going to be built or not, but the government shutdown will be over and then everybody will be happy. Or second scenario, earnings won't be that great. We're going to have more revised guidance as we had with Apple a few days ago. And the market's going to crash for good this time. And it will be a bear market. And then we're going to be back minus 20%. That's could happen. And you know what? even a third option, maybe nothing's going to happen, or we're going to have mixed results and the year is just going to go sideways. And then we're going to discuss this in July 2019, like in 6-7 months from now, and we're going to have the same discussion. So you know what? Stick with your investment strategy. That's a lot better than trying to time the market. Rick, you're saying, Mike, various financial experts have said that one way to evaluate the investability of a potential stock is to compare its specific results to other stocks in the same sector. Where's the best place to find sector average value for specific metrics, such as ROIC or PE ratio, cash PE ratio, revenue growth, etc.? Oh, that's a very good question. I have access to that with YChart. You're pulling out this this question, and I might just add a little bit more information when I do my sector at DSR to include those kind of information. My bet would be to pay for a data service if you want to dig into those things. So probably maybe Seeking Alpha offer it too, because I know YChart is quite expensive. Maybe Guru Focus. Problem is another one that was great was Google Finance, but they took out most of their financial data. So, but yes, if you want to select like winners among the sector, one of the best thing to do, and I'm gonna use that question for something else, is a PE ratio of 12 is not good or bad. It depends on how the stock has been traded for the past 10 years, so how the market usually value that stock, and it depends on its peers as well. So if all the other companies are trading at a 15 PE ratio and this stock is trading at 12, either it's the deal of the day, or the market thinks that this one is dragging and will not work out. René, can you pull out? That's it. The Canadian Dividend All-Star list. Yeah, I know about it. Can you pull out the sector on it and compare different stocks from the same sector? That could be interesting. Also, oh yeah. Well, thanks for the resource. There you go, Rick. At least half of your portfolio will be covered. Joseph, please comment on how to invest a large lump sum while reducing the risk of being hit by a large market drop soon after. That's definitely a concern. I've went through this very situation in 2017. In September of 2017, I received my pension plan account. It was a big check of $108,000, so I was really happy to have it. And then I was like, "Oh my God, I'm investing at the peak, at the summit of the market. Should I really invest all my money right away?" Honestly, it would really suck if you invest a large lump sum amount, and we hit a bear market 3 weeks later. The problem is that you will not be able to know. So if you are not comfortable with that, what I would suggest you to do is to take your lump sum and divide it throughout the next 6 months. So this will give you, use trailing stops. You can do that too. Sees that's a good idea. But I'm not a big fan of trailing stops if you're buying a stock that you really like, because you're just going to be forced to sell for no reason. So I'd rather hold on to it. And I'm going to give you 2 examples. Imagine back in 2017 in September, I bought shares of Microsoft and Lazard, as I mentioned earlier in this presentation. So Microsoft went from $75 to $110, so I felt like a genius. And Lazard went from like that 30-something dollars I paid for to $57, and then go back to that same $30,000, $30 or something like that. So basically, nothing happened with Lazard. I wish it was all Microsoft, but you know what? At one point, you'll have to invest. If you're not comfortable, and I can understand, I mean, the last thing you want is to invest $100,000 and look at your portfolio a month later and see 80,000. That would really hurt. Yes, 25% could keep you a long time. But the thing is, if you wait 25%, you might as well just keep it or revise your investment thesis if you're down more than 25%. So yeah, so it would suck if your portfolio is down $20,000 right up front. So go like establish your plan, establish like the portfolio where you want to get. So have like all the stocks you want to buy and start buying them shortly, like just like use maybe 10-15% of your money each time. So you're going to cost average. If the market goes up, it won't hurt too much, and if it got the market goes down, you'll have a small opportunity to add a little bit more shares to your portfolio. Adrian, you're asking, when building a portfolio, is it better to automatically drip your current holding or reinvest your dividend by myself, picking new undervalued position? I'd say it depends where you stand with your portfolio. If you're adding more new money all the time, if you're in the accumulation phase, it doesn't really matter if you drip or not, because you can use the dividend proceed plus additional capital to build new position. But at one point in time, you don't want to end up with 50, 60, or 100 stocks in your portfolio, because then it would be the same thing as investing in an ETF. So you're better off keeping the number of different companies around 30 to 40. That would probably be the optimal number of different companies. So at that time, you're better off dripping. I mean, the overall thinking behind that is you pick companies that you like, that you have a strong investment thesis and that you believe in. So using drip to improve your position is a great way. Usually you can have drip program as well. So sometimes you can save like a 5% if you set it up directly with your broker, or you can save on transaction fees. So it's definitely a good tool to grow your portfolio. But if you're building it and you want to add new position, stay cash with your dividend and then use it to buy under new stocks or rebalance your portfolio as well. Joseph, you're asking the difference between picking dividend stocks, as I seem to propose. Yeah, and I explain why I do it. I love picking up stocks because I like to be involved. Why it's preferable to buy dividend ETF? I think that there's no real answer here. Both strategies have pros and cons. So the reason why I pick dividend stocks instead of buying ETF, the first one, I have a large amount of money to invest myself. So I can diversify myself, and I like to be involved, and I like to know each company that I invest in. So those are the reasons why I pick my stocks. What I don't like about ETF is that each time I look at one ETF, there are companies inside that would not fit my investment strategy, that would not fit my view or my investment thesis. So this is why I'm not that kind of guy that will go for dividend ETFs. On the other side of things, if you don't want, like I mentioned, if you don't have the interest, the knowledge, or the time to manage your own portfolio, dividend ETF is an amazing way to get instant diversification. You reduce your risk because you have, like, those have been taught for you. So when we were talking about sector allocation in the presentation earlier, this is where it comes into play, because those ETF are usually better balanced than some investors' portfolio, and they kind of keep track of their asset allocation, so you're not getting off. So those are the main advantages. As I mentioned, it's more a preference for investors than a real, like, there's no real truth over there. Some people will do very well with ETF, some others will fail. Same thing for dividend stocks. Rick, how much importance do you place on beta value in terms of investability of particular stock for a retiree? Obviously, retirees don't want to own a portfolio with high volatility. I totally agree with you. Actually, I think, like, the beta value will tell you how much, like, the stock will fluctuate compared to the market. So obviously, you want stock that will do, like, not better, but like will be less volatile. But I would more put focus on the dividend payout ratios, as I mentioned, depending on the type of stocks. Obviously, if you're looking at NII or AFFO or the cash payout ratio, but I want to make sure that the company pays its dividend, and I want to make sure that the company has enough room to at least increase it to keep up with inflation. Those would be two things that I would put forward before looking at the beta. Mostly because yes, you suffer some volatility, but if you keep getting paid and you receive higher income year after year, this should be your most important concern as a retiree, instead of just focusing on the fluctuation. And one trick I used to give my clients when I used to be a private banker, like what I would have done in December, I would have called most of my clients and say, you know what? Sometimes in January, you're going to receive your statement, your investment statement. Don't open it right now. Just wait a little bit longer. It's going to be ugly. So wait until you receive the one dated March 30th instead of December 31st. So avoid heart attack by looking and tracking down the fluctuation going up and down, because it's going to drive you crazy for nothing. Linda asked, would you ever use a large stop loss to get out of a long-term holding when you hit that minus 20% level? I use stop loss in one type of category for my own portfolio. So that is a very personal answer. It's not necessarily something that everybody should do. In my portfolio, the bulk of my portfolio is built as a core portfolio. So those are companies I want to hold for almost ever. And I have other stocks that I'm picking, probably from my previous life when I was actively trading on the stock market, that I'm trying to pick undervalued stocks that are either falling nice or represent higher risks. So basically what I do is, a good example of that was Shopify and Canopy Growth that I bought in 2017 and early in 2018. Both of them were showing over 50% return during the summertime of 2018. I was unsure on keeping them because those were just like short-term thing that I wanted just to ride some bullish movement. So I put stop sell at a specific amount, make sure that I protect that 50% profit bar. And then I went on vacation and toured the Maritime for almost 3 weeks. During that tour, the two of them dropped and then triggered the automatic sell. So this is why I just wanted to protect my profit on those. But if there were companies that I wanted to keep forever, I would have probably not do that. I would have probably just rid them. And as a good example, if you have put stop loss on December, and you hit those levels, now you're looking at the market, it's back up by 10% and your cash. And all those companies are getting back to life. And you're left with, you're left with the same question. Is the market's going to go back up again because it's up 10% since December 24th? Or this is just a small bump before it goes down by another 20, 30%? And nobody has that question, the answer to that question. So there you go. Maybe this is the correction that we were supposed to have, and 2019 will be a decent year, and then you're going to get stuck in cash for a long time. Lorenzo, will this webinar will be recorded and available after? Yes, there will be a replay. It's being sent a few hours after the webinar is done. Now I'm already after over an hour and 20 minutes, so it's going to take probably like by the end of the day you're going to receive it. But yes, you're going to receive an email with the webinar link, and feel free to share it with others. Anybody could register using the same link, and they will get the replay right away. So yes. Enric, what are your recent thoughts on Enbridge? The current dividend yield and the company projected dividend growth of 10% through 2020 sure seem great, but on the other end, the debt situation, payout ratio, and pipeline delays are concerning. I think you did a pretty good resume of the situation of Enbridge. I have it in my portfolio because I think right now it's undervalued because of the concern around the pipelines. Keep in mind that those pipelines are somewhat necessary right now. It's a necessary evil in terms of an environment and everything, but we need them. I mean, the economy cannot roll without those pipelines. Right now, the company has sold non-core assets. They are on good way to have line 3 replacement done. They did increase their dividend in 2018 and in this year by 10% as announced according to their plan. I trust management on that. And the reason why I trust them as well is because they haven't failed investors for the past 25 years. So yes, there are concerns, but I think they're on the right path. They have booked their financial structure to make it happen. Obviously, this is the kind of stocks that you want to follow quarter to quarter to make sure that things doesn't go sideways, because the investment thesis behind the whole thing is they will get their like 20 billions worth of project on that they have on paper on the road. If they make it, then you're going to make a lot of money. If they don't, and there's problem going on, then we're going to have other problems as well. The stock's going to collapse, and the dividend may be like not cut, maybe cut as well. You never know. But this is why you want to make sure that you follow it closely. So far, I'm still bullish for Enbridge though. Vladimir asking, what do you think about WCP? How does it compare with other same sector? Can you make a stock card for this company? Yes. Well, for those who don't realize, Vladimir is a member of Dividend Stocks Rocks. As a member, you have the opportunity, you have the possibility to ask for stock cards on any companies that we haven't covered yet. So Whitecap Resources, is that the one that you're looking at? WCP. Yeah, that's the only one I can find. Yes, I really don't know this company, so I'll be honest, we're gonna take it down, make a stock cards. So basically the way it works, if you're a member, you send us an email saying, hey Mike, looked at WCP, find it interesting, what are your thoughts? And what we do is that we have our team look into it. It takes about 1 to 2 months because we receive lots of requests. This is a very popular feature. As I mentioned, we're trying to make 5 to 6 new stock cards per week, but we have right now we have over 100 requests. So we're trying to, my goal is to hire another employee in 2019 to help me out with DSR Pro and those stock cards. But yes, we'll take a look into it and we'll do a stock cards. Casey, you're asking about SPR. It's funny, those companies I don't know. Spirit Aerial System Holding, is that it? SPR, never heard of this one. You know what? I'm gonna take a look into it. Sorry, I don't know. Never been brought to my attention. Jay, you're asking, just to be clear on key metrics, should we equate payout ratio to EPS and cash payout ratio to free cash flow? According to definition in the white chart, yes, those are linked to it. The cash payout ratio is something that I don't calculate because you have to consider the capital expenditure in it, and sometimes it's not necessarily clear in the financial statements, and you may consider or may not consider stuff. So I rather use. You know what? I'd rather use the numbers from white chart and always use the same calculation, because basically, as I mentioned earlier, what is important is not the metric as itself, but it's the trend. So if the free cash flow keeps increasing, it's a good thing. If the cash payout ratio is stable and the dividend is increasing, it's a good thing. But a cash payout ratio of 60% is not necessarily better or worse than a cash payout ratio of 70% or 50%, depending on the situation of the company and at the time that you look at the key metrics. Because even with free cash flow, which is a metric that you cannot play around with accounting principles because it's real cash in your real bank account, the thing is, depending on when you look at the metric, you may have more cash flow or less cash flow because other events happen and then the company used that money for whatever project. Mike, do you use options to supplement dividend, take advantage of stocks dropping too much or jumping too high. I don't. Lots of people do it. They some write covered calls as well to increase their income as retiree. I don't play this game. I'm not saying it's a bad one. It's just that it's not my game right now. I'm more a classic dividend investor guy for now. I've started my career actually doing back office on futures and stock options. Worked there for a year, so I'm quite familiar with those strategies, but this is not something I'm doing right now. Laurie, you're asking, do I drip all my stocks? I don't drip right now, mostly because I am still building my portfolio. As you can guess, I am 37 right now, so I'm still adding more money to my portfolio as well, trying to buy a new position. And I right now at this point in my life, I rather use my cash to rebalance my portfolio or to add new positions than dripping. But then, as I mentioned earlier, both dripping and using money to buy new position are good strategies. CFD, you're asking me my thoughts on Enbridge. I've done that already. Hey, that's a good one. Adrian, having US stocks, is it worth to diversify into Euro dividend stocks, like through ETF or especially being a European citizen? Sorry, having a hard time saying Euro because it's easier in French. It's Euro. That is a very good question. As a North American, I would say no, because I have yet found a company on the European market that is doing a lot better and a way lot better for me to go and dive into those financial statements and go through hoops, because it's not exactly the same reporting and they don't necessarily report quarterly either. So for that reason, as a North American, I'm not very tempted to look into Euro stocks. As a Euro citizen, it's a bit different because investing in your own currency gives you a small edge for your portfolio. Even as Canadian, I have like 60% of my portfolio in US stocks, and I was invested the same thing back in 2017, like at 18 months ago, even though the currency exchange wasn't very great. But because the thing is, if you compare the euro to the US dollar for the next 30 years, chances are there going to be a fluctuation of either plus 10 or minus 10, but that's about it. So it won't, even at 20% over 20 years, it's not even 1% annualized return that you gain or you lose. So it's not the end of not the end of the world. It has a big impact on short-term returns. So if you look at your portfolio from one quarter to another, from 1 year to another, it will have a big impact. But overall, I've done this strategy versus Canadian dollars since I started investing in 2003. And sometimes I feel like a genius. Sometimes I'm getting hurt. And overall, it balances out. So it's more like if you're comfortable more maybe in looking into Euro stocks than others, that could be another reason why you could look into them. But it's not, to me, it's not mandatory. I think that the US market is more diversified and includes companies that had so much more power and so are like just amazing. Like companies like Apple, Microsoft, 3M, Johnson & Johnson, Procter & Gamble, those companies, you don't really have them elsewhere. So for that reason, I'm not looking too much into Euro stocks. Well, you're asking about this Team-Centrix impairment for AbbVie. AbbVie is on my to-do list to do the review, so I will have to get you back on that. Sorry, but I haven't read much about that impairment, so I need to get back on this one. Comment from Simon. My opinion on BPY, it's Brookfield Property, I think. BPY. Yeah, Brookfield Property Partner, why it's down so much. Actually, the thing with several stocks right now that are down, one thing is, especially with companies like Brookfield, either property manager, which is more like a REIT, but you also have in the same family, you have renewable partners, you have energy and stuff like that. Thing is that those companies, to be successful, they carry a huge amount of debt. Those have, like, we had lots of concerns, but when you look at the past 6 months, the stock is down 10%. It's not catastrophic. Over the past 3 months, it's down 12%. So you know what? As comparable, I'm just gonna take a look right now. S&P 500. So the S&P 500 for the past 3 months is down 10%. Brookfield is down 12%, and the TSX is down 6%. So it's not a big difference. They're not like dropping like a rock while everything else is not. They're just following the market right now. Main concern is that, definitely. So that's about it. You don't have to worry about too much. Brian, in addition to owning individual equities, would you recommend use covered call ETF to enhance yield for retirees, such as ZWB, covered call Canadian banks? A while back ago, I did, when actually ZWB, the covered call banks from BMO, got on the market, I bought some shares, and then I did a comparison between the covered call and holding the Canadian banks. And obviously it's not the same strategy, because the purpose of the covered call is to generate additional income, right? But overall, I would have been better after like a year or two. I looked at it and I would have been better holding like the 5-6 banks or big five than the WZB. You know, all those strategies include fees as well to be able to generate those yield. You pay fees for the ETF as well. So overall, I'd rather hold Canadian banks than going from covered call ETF. I'm not saying it's a bad strategy, but I'm not saying that you're going to get so much out of it. I'm the kind of guy that rather enjoy the stock growth on top of the dividend payment, especially when you're talking about Canadian banks and Canadian utilities. I think you have some very good picks in both sectors that you can enjoy both stock growth and decent yield. Kim, you're asking a very interesting question. If you wanted to get around $30,000 in dividend revenue on average, how much money would you need to invest? And Jean is answering back, probably between $900 and $1,000 and $1 million. Nancy is saying before taxes, you need around $750 at 4%. I think the answer is pretty much like in between. If you go the high yield route at 4 or 5%, you will need less income. The problem is building a whole portfolio of 4 or 5% yield isn't that impossible, but you have to be very cautious. At DSR, we did this, what we call them retirement portfolio. I'm going to share my screen for a second here. So we do have in our portfolios, we have the Canadian and the US portfolio. What I want to show you here is that our goal was to create a portfolio that generates between 4 and 5% yield. Here's the example of what we have in our portfolio right now. So we have Emera, Enbridge, Fortis, Canadian Bank, Royal Bank, Boston Pizza, Bell, Intertech Polymer. So you can see yield 5, 6, 4, 8%, 5, 8% for Inter Pipeline. So it is possible, but obviously you have some companies like this, like I can think on top of my head, Boston Pizza has been down by about 20% last year, I think. So you may suffer from some fluctuation. If you go that route, make sure that you select companies that at least increase their dividend following the inflation, at least by like 1, 2, 3% a year, to make sure that they can keep up. A safe bet would be $900,000 and invest in a portfolio that generate between 3 to 3.5%. That would be a great start. But you can definitely make it happen at 750. We have created the US and the Canadian portfolio in summer of 2018. After lots of work, I want to make sure that we have safe dividend growers over there that still pay a little bit higher in terms of yield. But the higher you go in terms of yield, the higher you go in terms of chances of having your dividend cut. I mean, there's no free lunch in finance. There's always a reason why a company is set to pay a 5, 6, or 7% yield. So keep that in mind when you do your own research, or register to DSR, look at our portfolio, and you'll have a very good start. Amza, you're asking, what are my thoughts about Enter Pipeline? We just saw it, 8% yield right now, I think. In terms of their Heartland Petrochemical Complex, also, do you think its dividend is safe? Right now, the dividend is safe, but obviously, the overall concern about pipelines, about debts, about regulators, those are all the things that are dragging down, and Inter Pipeline is not the only one. You look at Enbridge, you look at Keyera Energy, pretty much all pipelines are down right now. It's not a good time. The thing is, on the one side, you have pipelines that are being used almost to full usage, and on the other, the energy market is slowing down. Alberta might not pump as much resources as they used to. So those are all part of the group that I would say follow them quarter to quarter to make sure that everything is on pace. Right now, IPL is actually in one of our portfolios, so we're not too worried about it, but just be careful about it. Follow it like each quarter. Make sure that you keep yourself a small note to look into the reports, or register to DSR Pro and we'll do it for yourself. Lori, you're saying, how many stocks do you show in your safety rating website? The amount that we cover on a DSR, so this does not include our database for DSR Pro, but for DSR, we have about 200 US stocks and 100 Canadian ones. That's about it. We cover a total of like 325, 330 right now. As we increasing, and sometimes we take out like the bad ones when we're about to update those. We're taking out the sell ratings. So we do them when members are asking us to do it. But after that, we're taking them out. So we're probably going to go between 300 and 350 ratings for dividend safety score and pro ratings, roughly 2/3 US, 1/3 Canadian stocks. Obviously, we have a huge database behind tracking down about 1,000 stocks, because we're basically tracking any dividend paying stocks on the market, at least 1% dividend yield. We make a few exceptions like Visa or MasterCard, for example. But the overall is no ADRs and 1% and up dividend yield is being accepted for DSR Pro members. So this gives us a huge database, and those members have access to their portfolio and they get their rating updated on a quarterly basis. So what's on the website is updated whenever we review the stock or we review the rating on DSR Pro. So a DSR Pro member are the first one to get the rating updated, but everything that is on the website in terms of stock cards and ratings is updated at least twice a year. And you know what? Tracking down companies like from month to month is not really something that we do and that we believe in, because dividend growth investing is all about investing for the long haul. It's not investing for the next quarter or the next year, or what's going to happen in 2019 or in 2020, or if recession is coming. It's all about keeping a strong portfolio for the next 10, 15, 20, 25 years, 50 years if it's possible. So that's about it. Deb, what do you use Whitechart for? Well, actually, Whitechart is our system that we use to basically track down our portfolio returns, track down pretty much all metrics included in DSR Pro. We use it to do all our stock research. You also have economic data. You pretty much have everything there. So if you want to know the cash flow payout ratio over the past 10 years, for any stocks on the Canadian or the US market, you will have it. If you want to know how the housing construction is being doing right now, or consumer sentiment or retail sales on in Canada is doing for the past 5 years or 10 years or 15 years, you can get that from YChart as well. So we're using this for pretty much everything. It's a great stock screener as well. So we can pull out all the data we want, identify from sectors to sectors using our key metrics. That's a huge database with infinite possibilities, basically. But as I mentioned, it's a few $1,000s a year. So unless you manage a large portfolio or you have a business behind it where you can use it for your own personal good and use it for your business at the same time, I don't know if it's worth it or not. Like for me, it's a no-brainer because I run my business with that, and all the data that we need for DSR is being taken from YChart, most of it. But if not, I don't know if I would pay like $3,000 or $4,000 a year for my own portfolio, obviously. Carol, you're asking my thoughts on Apple for 2019. I'm gonna give you my thoughts for Apple forever. Right now, next year, in 6 months, Apple for me is a keeper. It's my largest holding in my portfolio. The reason why it's a keeper then is, from time to time we have this story about Apple is a one-trick pony. It's an iPhone company. iPhone sales are struggling. They're going to get beaten down, and now the business is going to go down. So this is the bear story that we keep hearing from analysts and stuff like that. And every time that we have sales miss in terms of iPhones, we have the stock that goes down. But Apple is a lot more than that. First, they generate tons of cash flow, so they are able to do other things and adapt. And this is exactly what they're doing right now with their services. Not too long ago, services was just a cool thing to say in their quarterly statement. Now it's a $10 billion quarterly. So I did. After an hour and 45 minutes, I'm having a hard time concentrating. Sorry about that. Services for Apple now generates $10 billion in revenue per quarter. So we're talking about a $40 billion business. This keeps growing double digit from quarter to quarter. So this will be the next big thing. Apple is investing in AI, maybe in autonomous cars and stuff like that. You have like plenty of other opportunities. And the fact that Apple is cash rich and still dominant and has created this incredible ecosystem. And this is how they crushed BlackBerry, by the way. It's because of their ecosystem. Everybody wanted to use their iPhone and their iTunes and their App Store. So everything was going towards... Thanks, Miro. Yeah. By the way, I'm not taking any question after Roger, okay? So basically, the company has built this friendly ecosystem. At home, we have iPads, iPhones. My wife has a MacBook. I'm still running a PC though, but everything else in my home is getting everything is everything connected together. So for those reasons, I think that Apple is a strong buy right now. I have it in my portfolio. I'm not buying more because it's already my largest asset and my largest position, but still a very good one. Roger, you're asking, what about REITs? You rarely mention them. Yields are good, but price growth rather poor. You actually kind of answer why I rarely mention them. I think that I do a lot more REIT analysis than I used to, mostly because a lot of members are interested in REITs. I'm going into REITs for my retirement stocks as well, the retirement portfolio as well. Upfront, I would say I'm not a big fan of retail REITs right now. I don't think that the future of retail is in brick and mortar. I think that online sales is obviously the way. So companies like Ryocan will probably not do so well going forward. I'm more interested into industrial REITs, so companies that are renting out manufacturers or facilities. Granite REITs, for example, could be an interesting one. If you really want to go retail, I would go with City REITs. So this is the REIT for Canadian Tire, mostly because Canadian Tire has a unique business model. They own their own brands like Motorcraft and Mastercraft and Motomaster. So because of that, I would go with them. If not, data REITs, storage could be interesting as well. But then again, the lack of growth is a bit of a downer for me. So this is why I'm not too keen on them. I think that having like 15% of your portfolio, maybe 20% if you're retired, could be interesting in REITs. But be very careful of REIT diversification and make sure that the AFFO payout ratio is in line, that the company is still able to increase their dividend year after year. If they are not able to do it, you know, I'm starting to get concerned about Boston Pizza. We see what's happening with Pizza. Both are not doing so well. It's hard for them, and they have lots of debts. So this is why, you know, having a few REITs is good. But over that, yeah, yield is good. It's good until it get cuts, right? We had artists that cut their dividend this year. We had Cominar last year. We had Boardwalk in Alberta a few years ago. So, you know, it's not because it's brick and mortar and it's because it's a solid REIT that it will not cut their dividend. So be careful with that. Okay, last one for Ryan, and then we're gonna wrap it up. Anyway, the webinar will automatically close after 2 hours. So there you go. Any advice for buying US stocks in the RRSP? Do I need a file W8? No, you don't. So basically, RRSP is regulated under a tax treaty. So between Canada and US, any stocks you hold in a retirement account, so it's valid for US investors as well. If it's in a retirement account, nothing happens. You don't have to pay taxes. The dividend is being deposited in your account. I would strongly suggest you to have a US RRSP. So then you receive US dollars in dividend, and they're not being converted, and you don't have to pay like 2, 3, 4% in fees charged by your broker. So if you receive like $50 in dividend from Microsoft, it will be 50 US being deposited into US RSP cash account. Very important for that. Besides that, if you invest in a TFSA, there is a form. Call your online broker. They will help you fill it out. If you fill out the form, you will pay 15% withhold taxes instead of 30%. But that's about it. The other 50% you'll have to pay. But on the DRSP, you don't have to do it. So, wow, that was crazy. Yes, so that's great. So René and Rick, you're now buddies from DSR. That's great. At one point in time now, we have over 1,000 investors, active investors in DSR. Most of them joined DSR since I started full-time working on that. Back in when I came back from my trip in 2017. So expect to add another 1,000 members this year in 2019. At this point, I think that we're going to look into creating a private forum for all the members, and more connection between René and Rick will happen. So thank you so much for being with us today. It's been a crazy webinar, almost 2 hours. So thank you so much. Make sure that you go back, get your bonuses. The link is quite easy. It's DSR, Dividend Stocks Rocks.com webinar/promo. I'm putting it back again on the comment section, or just use the offer button. Get down, get your your bonuses and give it a try for the subscription. You have 60 days to try it out. Get all the reports you want. My goal here is to help you invest and help you make money. If you don't, I don't want your money either. You know what? I'm living a great life right now, and I'm not here to steal money away from people. I'm here to help them. So if the DSR is for you, good. If not, that's not bad. At least you get a good report, and you still got those great webinars. So thank you again. I'll have another webinar in a few weeks. Stay tuned and take care. Cheers.